Welcome to Iron Financial. We're here to help you forge a stronger portfolio and cut right through the market weakness. I'm your lead analyst. All right, let's get straight to it. Today, we are tearing into a really confusing set of numbers from the government contractor SAIC. And you've seen this before. On one hand, they post some pretty strong results, but on the other, they turn around and slash their forecast for the future. It is the classic mixed signal. You know, the kind of thing that sends most investors either running for the hills or maybe, just maybe, running for a once-in-a-lifetime opportunity. Our job today is to figure out which one it is. Okay, let's dive into this.
So this is the big question, isn't it? This is the central contradiction that we have to unravel right now. You've got a company that delivers strong profitability. They beat their cash flow targets. Things are looking good. And then, in the very same breath, they turn around and tell the market to expect hundreds of millions of dollars less in business next year. I mean, on the surface, it makes absolutely no sense at all. It really feels like the company is telling two completely different stories at the exact same time. One story is all about a strong, well-managed operation hitting its numbers, and the other is about a business that's actively losing ground. So how on earth can both of those things be true? Well, that's the puzzle we're going to solve together today.
All right, first things first, to understand where a company is going, you absolutely have to understand where it's been. It's fundamental. So before we get to the storm clouds hanging over the forecast, we need to build a solid foundation by looking at the hard numbers SAIC just put on the board for their fiscal year 2026. Now this is the good news part of the story, and believe me, it is critical to understanding their larger strategy. So let's break these results down piece by piece and see what they really tell us about the operational health of this company.
Okay, now what's really interesting when you look at this chart is the story it tells. Just focus on the top line for a second, revenue. They came in at roughly $7.26 billion. Now, that was a slight miss against their own guidance of $7.275 to $7.325 billion. It's not a disaster, but a miss is a miss. They blamed things like procurement delays, even a winter storm, and honestly, this is where most people stop reading. They see that revenue miss and they immediately assume weakness. But that's a mistake, because the real story is further down the page. Look at adjusted EBITDA. That's a key measure of profitability. It shows you the cash earnings from the core business. They guided for around $695 million. They actually delivered about $705 million. That's a solid beat. Now look at adjusted diluted earnings per share. They guided for $9.80 to $10.00. They came in between $10.40 and $10.60. That's a significant beat. And now for the most important metric for operational strength, in my opinion, free cash flow. They guided for over $550 million. They delivered between $570 and $575 million. So here's the crucial takeaway. Despite that little hiccup on the top line, the engine of the company, its ability to generate real profit and real cash, is actually running stronger than anyone expected.
Hold on a second. Pump the brakes. I see the beats on the bottom line, and that's great. Nobody is going to argue with more profit and more cash. But let's not just gloss over that revenue miss like it's nothing. The top line is the fuel for the entire machine. You can only squeeze so much profit out of a business that isn't growing its sales. A miss is a miss, and to me, that's a potential crack in the foundation. Are we absolutely sure this isn't a company that's just getting better at managing its own decline? Because that is not a long-term strategy for success. That's a strategy for slowly fading away into irrelevance. It's one thing to be efficient, and it's a whole other thing to be shrinking. And I need to know which one this is before I can believe this foundation is as solid as you say it is.
That is a fair point, and it's exactly the question a smart investor should be asking. But I would counter that by focusing on this number right here, $577 million. That's the final audited free cash flow number for the full year, even higher than the preliminary range we just looked at. And listen, this isn't some accounting gimmick. This is real cash, cold, hard cash generated from their operations. A company that is fundamentally weak, a company that's truly decaying, does not generate that kind of cash. It's just not possible. This number tells me their operational foundation is solid. It tells me they're managing their working capital well, collecting money from customers, paying their bills efficiently, and they're running their programs like a well-oiled machine. The revenue mess is a data point, absolutely. You have to acknowledge it. But this cash flow number, this tells me the core structure is sound. Now, let's see how this all builds into that controversial forecast. And this is where the story takes a very sharp and, for many people, a very confusing turn. We've just established a picture of a company that operationally seems to be firing on all cylinders. They're beating expectations on the metrics that matter most for financial health. But then they released their guidance for the upcoming fiscal year 2027, and it looks like they're forecasting a major storm. This is the part of the report that sent a real chill through the market and raised all kinds of red flags. Okay, let's put the numbers right up on the screen so you can see it for yourself. Look at that top line. Their prior guidance for FY27 revenue was in the range of 7.35 to 7.55 billion. Okay, the new guidance, 7.0 to 7.2 billion. At the midpoint, that's a haircut of about $350 million. That is not a small adjustment, that is a significant, painful downgrade. But now, look at the next line, adjusted EBITDA percentage, which is just their profit margin. The old guidance was 9.7 to 9.9%. The new guidance is higher at 9.9 to 10.1%. And then look at free cash flow. They're holding it steady at over $600 million. I mean, this just brilliantly illustrates the contradiction we're talking about. Revenue is falling off a cliff, but they expect to be more profitable on a percentage basis and still generate a massive amount of cash. How does that work?
Whoa, wait. Let me get this straight. So they just finished a year where they knocked it out of the park on profit and cash, and their reward to shareholders is a forecast for shrinking sales? This just does not add up. How in the world do you get more profitable while your revenue is actively going backward? That sounds like financial engineering to me, not a healthy, growing business. It feels like a total smokescreen to distract from the fact that they're losing huge chunks of work. Are we absolutely sure we're not seeing some major cracks in the armor here? This is exactly the kind of guidance that makes me think that solid foundation we were just talking about might have some serious termites. That is the multi-million-dollar question, isn't it? And you're absolutely right to be skeptical. It feels completely counterintuitive. But the numbers don't lie. Sometimes they tell a very complex story. So let's address your point directly. We need to act like surgeons here. We need to go in and find the precise source of this revenue bleed. Where exactly is this $350 million hole coming from? Is this some kind of systemic weakness across the entire company, or is it localized to a specific identifiable area? The answer, as always, is in the details.
Now, before we go any further, we need to define a really critical piece of industry jargon, and that word is recompete. This isn't about going out and winning brand new work. A recompete is when a company holds a multi-year government contract that's about to expire, and they have to get back in line and bid against all their competitors just to keep it. Think of it like defending a championship title. It's a high-stakes defense of your existing territory. Winning a recompete just means you maintain your revenue stream, but losing one, that's a direct, immediate hit to your top line. An existing stream of revenue simply vanishes overnight. This concept is crucial because SAIC's entire revenue problem is almost entirely about losing a couple of very specific recompetes.
And boom, this chart lays it all out with brutal clarity. This is what's called a waterfall chart, and it bridges the gap between the old forecast and the new one. So on the far left, you've got the midpoint of their prior guidance, $7.45 billion. On the far right, the midpoint of their new guidance, $7.1 billion. The bars in the middle show us exactly what happened. This wasn't a death by 1,000 cuts, it was two major specific blows. First, they lost a recompete called Army RITS, and that took out a $200 million chunk of revenue. Then they lost another one, Air Force Cloud 1, which took out another $75 million. You add in another $75 million for just general market conditions, and there it is. That's your entire $350 million drop. So the bleeding isn't everywhere. It's highly concentrated in these two specific contract losses.
So, we've isolated the wound. They lost two big contracts. The skeptical view, the easy view, is that this is simply a failure. They competed and they lost. End of story. But here's the thing. Management is framing this not as some accidental setback, but as a symptom of a deliberate, calculated, strategic pivot. The argument they are making is that they are intentionally choosing to trade raw size for fundamental strength. They're willing to get smaller in order to get better. And this isn't unique to SAIC, by the way. We're seeing this across the entire government contracting space. The old days of winning just by being the biggest and cheapest provider of basic IT services are fading fast. The real value and the real profit is now in specialized, high-tech work. And SAIC is arguing that they aren't just reacting to this. They're trying to get ahead of it. They're adapting to a changing battlefield.
And here is the core of their entire strategy, laid out side by side. The contracts they lost, they fall squarely under the category on the left, commoditized enterprise IT. You can think of this as basic, large-scale IT services, running help desks, managing servers, the boring stuff. It's a tough business. There's very little opportunity to stand out from the crowd, which means it often turns into a race to the bottom on price. That pressure gives it lower profit margins, or what they call execution upside. And as we just saw, it's highly subject to being lost in a recompete. SAIC is saying we are intentionally moving away from that. Instead, they're focusing everything on the column on the right, mission IT and engineering. This is the specialized high-value work,
Think cybersecurity for weapon systems, or advanced data analytics for intelligence agencies. In this arena, they believe their expertise gives them a real competitive advantage, a stronger right to win. These are growing markets with much higher profit potential, and historically, they've had much better win rates here. They're shedding the low-margin, generic work to focus all their energy on the high-margin, specialized work.
All right, I have to jump in here. Choosing to shrink has got to be the best piece of corporate spin I've heard all year for we lost 2 massive contracts. I mean, how convenient is it to suddenly decide that the business you just lost is business you never really wanted anyway? Any management team in the world can stand up after a bad quarter and claim it was all part of some grand strategic pivot. It is the easiest story in the world to tell. But how do we know it's real? How do we know this isn't just an excuse to paper over a major failure in execution? I need more than a slide with a bunch of buzzwords on it. I need hard data. Show me the evidence that this is a genuine, long-term strategy and not just some convenient story they cooked up last week to save face with investors.
An excellent and absolutely necessary challenge. And this slide is the answer to that challenge. This isn't a story they just invented last week. This chart shows their revenue composition over 3 fiscal years, 25, 26, and their new forecast for 27. The dark blue portion is their core business, what they call the rest of SAIC. The light blue portion sitting on top is that large enterprise IT, the low-margin, commoditized work we've been talking about. Now just look at the trend. In fiscal year 2025, that business was about 17% of their total revenue. In FY26, it shrank, and now in their forecast for FY27, it's projected to fall all the way down to just 10% of the business. This isn't a one-time drop. This is a clear, multi-year strategic de-emphasis. They have been actively shrinking their exposure to this kind of business for years. The recompute losses we saw were simply the final, most visible step in a strategic pivot that was already well underway. This is the hard data that proves the narrative is real.
And that trend perfectly explains the paradox that we saw earlier. This is the trade-off they're making, plain and simple. By intentionally letting go of hundreds of millions of dollars in lower margin revenue, the remaining business, the more profitable, higher value work, automatically becomes a larger percentage of the total company. The mix, as they call it in the industry, improves. Think of it like a baker who stops selling low-profit everyday bread to focus exclusively on high-profit custom-designed wedding cakes. His total sales might go down and he might serve fewer customers overall, but his average profit on every single sale goes way, way up. That is exactly the dynamic that's at play here.
Which brings us right to this number, 10.1%. This is the high end of their new, and remember, increased adjusted EBITDA margin guidance for fiscal year 2027. This is the payoff for taking the painful medicine of a revenue drop. They are guiding the market to expect that for every single dollar of revenue they bring in next year, they will be more profitable than they were before. They are sacrificing sheer size for the sake of higher quality, more profitable business. This number is the direct mathematical result of that strategic pivot away from that commoditized work. They are building a smaller, but structurally more profitable and, they would argue, a much more durable company for the future.
So after all that, what is the final verdict here? What is the bottom line for an investor who's trying to make sense of all these confusing signals? Well, it all comes down to how you view this strategy. Because, make no mistake about it, this is a gamble. They're making a bet that the market will eventually reward them for building a more profitable, more efficient company, even if it means sacrificing that top-line growth in the short term. It's a classic bet on quality over quantity.
So let's just summarize the key takeaways. Let's put a pin in this. First, SAIC is making a very intentional trade. They are giving up top-line revenue to boost their bottom-line profitability and their margin percentages. Second, they are actively focusing their portfolio on the specialized, higher-value engineering and mission IT work where they believe they have a real, defensible competitive edge. Third, this means they're consciously letting go of those massive but commoditized contracts in order to build a stronger, more resilient core business. Fourth, and this is absolutely crucial, throughout this entire painful transition, they project the ability to maintain and even grow their free cash flow, targeting over $600 million next year. And finally, it's all part of a plan they call Improve and Invest. They are shrinking certain parts of the business to free up the resources and the focus needed to invest in the areas where they can truly grow and win. It is a textbook case of shrinking to grow stronger.
Which leaves us with the final critical question for every investor watching. SAIC is clearly trading size for strength. The data shows that's not just spin. But is this the necessary, difficult, heavy lifting that's required to forge a more resilient and durable company for the long term? Or, as the skeptic in all of us fears, are these moves just masking deeper cracks in the armor, a fundamental inability to compete and win across the board?
The numbers certainly support the strategy, but the execution of that strategy is what will ultimately determine the future. That is the gamble, and that is what investors will be watching very, very closely.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.